All right, so this is the third live session we've had. Um, so today, if I can get this to advance, I want to talk about some fundamental basic things that you know I get questions about from friends and family, and maybe some of you have had these same questions. But I want to talk about why invest in stocks in the first place, and many of you have probably understand this, but for those who are going to watch the recording later, this could be useful, and just kind of put yourself in the right frame of mind. And then I also want to talk about why invest in stocks via options, which is kind of what I have discovered over time is that I really do think that options now, while they seem, and you hear in kind of the mainstream media that options are risky, I think if done right, actually can work to reduce your risk, and reduce the risk of you experiencing, an extreme drawdown, or putting yourself into a situation where you're going to panic, like a lot of people did in 2008 when their retirement was cut in half, within a matter of months. And then I also want to talk about some of the advantages of being an individual investor, because often I hear, there's kind of two different camps in the investing world. There's those that say you shouldn't invest your own money. You should just invest in an index and be a passive investor, because you know you can't beat the market. You can't go up against the Harvard PhDs who are crunching numbers and trying to figure this out, working for the big hedge funds and institutions, right? And so you should just be a passive investor. But there's actually structural issues in the market that we'll talk about a little bit, that actually give individual investors an advantage, and you can use that advantage to do better than the general indices. And then I want to talk a little bit about value versus momentum. I don't know if you guys have heard these. I'm sure you've heard of value, but I don't know if you've read things on momentum, or I've kind of heard this debate between value and momentum. But in my experience, I think you should invest in both value and momentum stocks. Uh, there are studies out there showing that value and momentum both uh, are factors that will beat the market over time. And so if you leave one out, you kind of are only getting half of what you could. So we'll talk more about that. And then finally, just wanted to talk about selling puts. And so we'll see where that gets us. I think I always um, kind of underestimate how long each of these sessions are going to take, but we'll try and get through it in the next hour or so. And feel free, any of you, to jump in. I mean, I think it makes things more interesting when people jump in and provide their own thoughts, or if you have any questions, or if we just want to have a discussion on a particular topic, feel free to chime in. So, and a lot of this, I'm sure, is taught by Phil Town in his course, but just in my own experience, since I started investing. My grandmother got me in investing when I was 14. So I remember buying my first shares. She was a big fan of General Electric. So my first shares were in General Electric. Um, but why invest in stocks? So, I mean, if you really think about it, most wealth is created from um, investing in and owning businesses, right? And for most of us, initially we think, well, that's hard. I'm never going to start a business. I'm never going to be an owner of a business. Um, so I can't really participate in this wealth building activity. And if you look at the Fortune 400, I mean, I just took the first 12 from 2019, so it's a little bit outdated. I know Elon just jumped up to number 3 or 2. I can't remember which, with Tesla going up so much. But I don't know if you can see it, it's pretty small. But I mean, if you look at this list, pretty much every single one of these top 12 guys is they generate the wealth not from real estate, but from investing in businesses or starting businesses, right? And so when you buy a share of stock, and this is what, you know, I'm surprised at how many people, you know, don't understand this. And in my opinion, they should teach this stuff in elementary school or junior high at least. But when you buy a share of stock, what you are buying is a piece of a real business, right? You are buying an ownership stake in the business. Now you may own, you know, a very small fraction of the business, but you're still an owner of the business. And as an owner of the business, that means that if the value of the business increases, then the value of your stock should also increase, right? Because as a shareholder, you're entitled to number one, the earnings of that business. Now you don't decide, you can't decide, management of the company will decide how much of the earnings they distribute to you as a dividend or through share buybacks, and we can get into that maybe in another session. But you also secondarily, when you own a business, right, if the you actually are entitled to a pro rata share of the assets of the business. Now that doesn't happen very often, but let's say a business were to close, you're technically entitled to, you know, let's say you own 5% of the business, you're entitled to 5% of the net assets. And then when you think about it, compared to kind of alternative options, as far as what you could do with your money to generate a return, with stocks, you can start making money from day one, right? You buy the stock and it could increase in value the very next minute, based on what the market's willing to pay. You don't have to wait around for years to finally make money. Whereas, and I've been involved with a couple of startups and trying to create a profitable business, and it's not easy work. I guess I can tell you, you generally, when you're starting your own business, you've got to put in a lot of time and money. You generally experience losses for a few years before you finally maybe turn the corner and start making a profit. And then there's huge risk, because if you're putting all of your net worth into that business, if the business fails, then you lose everything, right? And you don't have kind of the benefit of owning stakes in multiple businesses, maybe in multiple industries. For example, you know, with this pandemic, right? There are a lot of people who have small businesses, especially in some of the, like the restaurant or tourism business. Their entire nest egg is in that business succeeding. And unfortunately, I mean, this is a way out of left field thing that nobody thought would happen. But they're not diversified into multiple things. And so if the business goes under, then that's, you know, maybe their entire retirement, their plans are kind of totally, you know, turned upside down. So, and then also with investing in stocks, I mean, we've all heard about the magic of compound interest and Einstein saying it's the eighth wonder of the world. But it's really kind of switching your mindset from, we tend to think about things linearly, right? And so if we think about growth, we think about kind of linear growth, which would be this purple here. If there was no compounding of interest, you were just growing at a steady rate, that's kind of how your growth curve would look. And then you've got the compound interest, where you're essentially building, getting a return on the previous returns, right? And I wish this graph went out like 30 years, because it, becomes a much more dramatic curve going out that far. But you can kind of, I think now all of us have a better appreciation for exponential curves because of the pandemic, right? Because we were all like thinking like, okay, if this doubles every 6 days or whatever, then we get to this astronomically huge number in a matter of months. And so I think now we're kind of finally appreciating exponential growth, but generally it's hard for us to kind of picture what that looks like. And so the most difficult thing is, as you start out, you may not see your account growing very fast or by very much, but you've got to understand that the huge chunks of growth come in the later periods, but you have to get there first, and so you've got to start somewhere. And so it's just keeping that vision in your mind, based on kind of your long-term goals. And maybe I'll ask you guys, I mean, are you primarily investing and learning about investing for like retirement? Is that your purpose, or is it just to generate some side income? What's kind of your goal?
My answer to that would be yes.
Yes to both of those.
Yeah.
Yeah. That's the same way I. For me, it's the same. Yeah.
Yeah, mine is probably to, I'm more or less retired now. I have been winding down for the last 2 or 3 years, and it's really to manage my lump sum that I got from putting it into insurance companies when I didn't know much about investing. So it's only in recent years I've started learning about investing. So it's probably not a great time in life to be doing this, but better late than never. But I really want to invest my own money rather than let somebody else invest it. So that's where I am. And trying to invest it safely, trying to find a safe way of investing. So that's why I originally went to Rule 1. I felt that it was a safe way of making a decent return. So that's really where I am with investing.
And I've always been focused on retirement, but I kind of did like a 60-40 in mutual funds and then manage 40% because I never had the confidence to manage everything for my retirement. So I'm building towards the confidence to manage all of the stuff myself. And I'm trying to get enough knowledge to have a side hustle in options, but I'm nowhere near there yet.
Yeah, no, I think that's great. And yeah, like I said, myself, it's both. So I've got my kind of retirement account, and then I've got my personal account that's not kind of a tax advantaged account, right? So it's both, and it's nice to some trades and some investments are maybe more, a little bit more short term in nature, and so you can kind of figure out where that fits in your long-term plan. Is this just something for some side income, or is this something that is you're using to a strategy maybe you're using to build your retirement account long term? And there may be different kind of risk tolerances in those different accounts. So I think it's a good idea to kind of have different accounts, and maybe you do have some different goals for those accounts. But Sean, I think, go ahead.
This is Danny. I was just going to say, so I have a standard account, and then I have a Roth account for myself, and then I also set up a Roth account for my wife, just because they have a max amount you can deposit in there per year, and that gives me the ability to do double the deposit.
Right. Yeah, and just for those who don't, I mean, I believe the limit for a IRA account is now, is it 6,000 or 6,500, somewhere around there for each individual?
I think it's 6,500. They just upped it this year.
Okay. Yeah, so you can put away, that much per person. So if you're a married couple, each of you can put 6,500 into an IRA each year, and that means that that money is not taxed, right? And so when it's tax time, I always find myself like, oh, let's see, how much can I put away, because that's going to save me on taxes. Money, some of that money would have gone to the government, and so I might as well put it into an IRA. With a 401k, if you have a 401k through your employer, or I think there are self-employed 401ks, you can put quite a bit more. I think at least a couple years ago it was around 17,000 or 18,000. It probably is higher now per person. So if you're a married couple, I think it's even more. So there's ways to avoid taxes. So, and then another reason to invest in stock. Oh, what I was going to say before, though, to Sean is, I don't know if you've read any of you have read the books from Ken Fisher. So I think I posted a few of his articles on the Discord group, but he usually writes an article, at least I think monthly or so, in various publications. And in my opinion, he's probably the best macro guy out there, having kind of a broad view of the market. And he definitely called it on the market when we were crashing back in March. I mean, he was writing that that look, don't panic, because these things kind of tend to have a way of bouncing back, and in his opinion, that this one was going to bounce back sooner rather than later. And he runs like a $50 billion hedge fund, and his books are full of little nuggets of kind of wisdom as far as facts about the market. So his firm will do what they call capital markets research. So they're kind of like an R&D type of a firm, where they're doing all this research and development on the market. They're looking at past price movements in conjunction with past events. So like they'll look at presidential cycles, and what generally happens when a Republican president wins the election versus a Democratic president. What happens when on the following year. He'll talk about what happens generally in the third year of a first term president. So they're going like super granular and looking at all the historical data to kind of, what they're trying to do is uncover the market psychology, right? So for example, with the presidents, I think he said generally if a Republican wins in the election, the first year of that president's term, the markets generally don't do so well, which you might think, and a lot of this is counterintuitive, right? Kind of the conventional wisdom that we all thought he kind of shows as faults. And the explanation for that one is, so in the election year, if it kind of looks like the Republican will be the winner, stock prices generally will climb in the election year, which would be like this year, right? And then if the Republican wins, what ends up happening is the market overestimated what that pro-business Republican could do for the economy. And they start to realize in that first year, okay, this isn't like some panacea where we're going to have this great economy just because we have a Republican president. So it's like the expectations were too high, right? And then on the opposite end, if a Democrat wins, that first year of that term generally is a really good year for the stock market, because and then the year of the election is maybe not so good, because people are fearing that the Democrat is going to ruin business, right? And then in the first year of their term, they realize, oh, it's not as bad as we thought. It's not like we're going to end all free capital markets because we have a Democratic president. And so people start to realize it's not as bad as we once thought. So those are some of the insights you can glean from Ken Fisher. but that was a long tangent. What I was gonna say is he often talks about, for those who are retiring or near retirement age or have recently retired, a big mistake that people make is, at least these days, when you retire, you could have, 20, 30, even 40 years of life left, right? Which is kind of like the duration we talk about when we talk about brand new investors, who are in their 20s, like, oh, you've got 20, 30, 40 years to invest and compound your returns. But we often kind of just think at age 60 or 65 or 70 that we're done. And then you should just go to all cash or very safe investments. But he's saying in his books, think about it more long term. Like if you lived another 30 years, you actually have quite a bit of runway for compounding to take effect. So just wanted to point that out. So this slide here, what I wanted to point out, and I'm sure some of you have kind of heard this, but the first time I kind of heard this, and I was not sure I believed it, but if you really look at the mega cap stocks, meaning the biggest, most followed stocks in the market, for example, like an Apple or a Microsoft, even then, kind of on an annual basis, from low to high or high to low, you see like a 40% move, even in 1 year, right? If you look at the low for the year and the high for the year. And so that tells me, if markets were perfectly efficient and really did discount all known information into the price, and therefore at any given time provided you with the actual value of the company, you shouldn't see the price fluctuating that much in kind of every 1 year period. And so I just put up the Disney chart for this last, not even a year. It goes back, I think, 8 or 9 months. But you can see, right? I mean, we were kind of up at 150 at one point in this last year, down to 80. And do we really think that the value of Disney's business got cut almost in half at any time in this year? Me personally, no. Like the value of the real true intrinsic value of that business has not changed by that much. And so I just point this out to say, when you invest in stocks, the advantage you have over other asset classes, maybe like bonds or real estate, is that you get these opportunities that Mr. Market presents to you, and you can take advantage of them, right? And so you can just wait oftentimes, because sometime during the year there's probably going to be a big down move or something, and then you can just take advantage and load up on shares at that point when the market's kind of being maybe irrational, right? And or on the flip side, when the market's being too exuberant and has bid up the stock to maybe way above where you think is fair value, then you can take advantage and sell at that point. With real estate, at least here where I live, I mean, maybe the real estate prices fluctuate 10% in a given year, but generally maybe not even that much. So yeah, I think that's a huge advantage that you should be thinking about. Any thoughts on that? Okay, if not, we'll just keep going. So for the argument that you shouldn't try and beat the market, you don't really have an advantage, and these are kind of the what I would say. Number one, as an individual investor investing your own money, you are more nimble. So the big institutions and pension funds and hedge funds that really do have the power to move the market, well, it takes them like 6 to 12 weeks to get it, buy in and sell, or sell a position, just because they're buying so many shares, right? So they have to do it over time, because if they did it all in one day, they would, if they were trying to buy, especially if it's a maybe a mid cap or a small cap stock, they would totally bid up the price against themselves. So they really need to do it over time. So for them, if they decide they want to get out of a stock, it's not like they could just do it that day. I mean, it's a slow process. And so just you can be much more nimble. If you decide one day, you know, facts change and you no longer like a company and want to get out, you can do it that day, right? You don't have to do it over a 3-month period. You can also maintain a long-term focus, whereas these managers of these big funds, I mean, it's their career, it's their job. They are measured for whatever reason. We just have this tradition of measuring people in business based on 3-month increments called quarters. And if your quarterly performance is poor for too many quarters, then you'll find yourself out of a job, right? And so if you constantly have that pressure every 3 months to be performing better than your peers, that kind of causes some problems probably in your underlying like investing decisions. You may not be making the most rational decisions all the time because you're just afraid. You're always in fear of losing your job. And so as individual investors, as third bullet point, you can wait for what Warren Buffett calls fat pitches. So you can just sit there and do nothing until you find something that you like and want to buy, right? You don't have to be active in the market every day or every quarter even. You can just sit there and read about things and do your research, and then finally when you stumble across something that you think is interesting, you can take advantage, but you don't have the pressure to constantly be doing something. So oftentimes just sitting and doing nothing is probably the right move. Like I mentioned, you don't have career risk. You can invest in things that professionals can't. So if a stock has some maybe a bad quarter or two, you'll find that the market quickly runs away from that stock like it's a burning building. And that's because these professionals don't want to be invested in something that just looks bad in their portfolio, right? They don't want to go back to their investors or the people who hired them and say and show them, look, here's my portfolio, and then they see that there's kind of stocks that are in the news to be down huge or poor investments, right? So they just have to sell them because they don't want to be associated with those type of stocks. But maybe those are really kind of diamonds in the rough, and they're just having a couple bad quarters, and it's not like a long-term risk for the company, and the company can make a few tweaks and fix things and get back on its feet. But they don't want to stick around to wait for that. And so that's where you can come step in and buy on the cheap because everybody just headed for the exit at the same time and drop the price. And I think this last bullet point is important. I mean, I think it's important to only be accountable to yourself. And if you're accountable to outside investors, like I said, you're inevitably going to feel a lot of pressure to do certain things, and rational decision making kind of goes out the window. So you can just keep calm and carry on when you are investing your own money. Any questions or thoughts before we go on to this kind of next topic?
Nope.
Okay.
No, that's fine with me as well, Steve. Thanks.
So why invest in stocks via options? So probably most of my investing now is not actually buying the underlying shares, although I still do that. Okay, and there's different situations where I'll do that. Number one, not every stock has a liquid options market. You got some stocks, generally smaller cap stocks, not as widely followed stocks. They will not have liquid options, and so it doesn't make a lot of sense to use options to invest in those companies. So in those instances, I'll find myself just buying the shares. Generally, I wish I could use options, but it's not always the case. And maybe you still come across a good company and want to invest in it, so you'll have to buy the shares. But you guys, I'm sure understand this by now, but for those who are new in the course and new to options essentially provide leverage. So you don't have to have as much capital. You can put up less capital, meaning money, to invest in the stock. And in other words, let's say you had a stock that's trading for $100, right? If you wanted to buy 100 shares of that stock, that would cost you $10,000, right? Let me just write this: 100 shares, right? At $100, that's going to be $10,000. But if you actually, can you see my drawing on the screen or no?
No, we can't.
Okay, I think that's because I think I shared this specific program instead of my screen. Just one second. I'm gonna fix this really quick. Okay, can you still see the PowerPoint?
We can see it.
Yeah.
Can you see my drawing here?
Oh yeah, we can see some. Yeah,
Okay.
solid.
So if okay, so it's $100 stock, right? And we buy 100 shares, it's going to cost $10,000, right? You can see that.
Yep.
So if the stock goes up 10% to $110 a share, right? And I still had my 100 shares, then now it's $11,000. So I made a 10% return, right? But let's say that I bought an option, a call option, so the $100 strike price call, and let's say it expires in 6 months or so, well, now let's just say it expires in 3 months or something like that, and let's say I bought it for $5, which is really that's options. I'm sure you guys know are quoted in per share increments. So you've got to multiply it by 100 because each options contract is it gives you the right to buy 100 shares. So it's really $500 for that $5 call option, or that $100 call option. So I spend 500, right? If the stock goes to 110, like I said in that example, then this option would be worth $10 a share or $1,000 for the total contract. So a 10% move in the underlying stock was really 100% return for me if I bought the option, with the capital that I invested. So you can see that your returns are much greater on the option than it would be if you just bought the stock, and you put up less money at risk, right? The most you could have lost if this stock went to zero is $500. If you bought the stock, you would have lost $10,000. So it protects your downside as well.
Would you ever execute that trade to get the shares, or would you only always get out and take your profit?
Yeah, generally, I don't think I've really ever exercised my option on purpose. So it's somewhat of a hassle, and sometimes you have to pay fees to your broker to exercise. So I think what most people do is just sell the option contract before it expires, like even on the day of expiration. Because especially on the day of expiration, I mean, your option should all be intrinsic value, meaning if there is any value, it's going to be reflected in the price of that option almost exactly, and there won't be any time value left. So just, I don't know if you saw the that recorded course that I posted a couple weeks ago. We talk a little bit about it there, but maybe let me just, for the benefit of those who are not super familiar with options, when you buy a call option, we're just talking about call options right now. There is an element. Actually, I think I have a. This will give me more space. Can you see this whiteboard thing here?
Yes, we can see. Well, it's a blackboard, is it?
Blackboard, yeah. Good point. So whenever you buy an option that has time left on it before expiration, you're going to have an element of the value that's time value and an element of the value that's what we call intrinsic value, if there is any. So in our example, the stock was trading at $100, right? And we bought that $100 strike. So we bought $100 strike call, and we said it expired in 3 months. So expires 3 months, right? So it's going to have time value because there's time for the underlying stock to move up or down. In this case, if we bought a call, we want it to move up. So there's a possibility that it could move up a lot or a little, but there's nevertheless a possibility there. So the market's going to value that time, that 3 months you have. They're going to give a dollar value to it, and that's why your option contract has value. Because right now, when the stock is trading at 100 and you buy $100 strike, that's called an at the money, an ATM option, because it's selling right at the same price as the same strike as the price of the underlying stock. So let's say we paid, I said $5 for it. So let's say this is your $5 of value here. We got 1, 2, 3, 4, 5 pieces here. Now, at first, because the stock is trading at 100, you have the right to buy it at 100. There's no intrinsic value, because a right to buy it at 100 when I could just buy it in the market for 100, that's not really valuable. I mean, I might as well just buy it in the market for 100, right? So why would this contract have any value? So that means that $5 I paid, this is all time value. I'm paying for the 3 months time and the possibility that the stock could go up, right? And then this contract would be valuable, would actually have intrinsic value, because I can buy the stock at a price lower than the market. So let's say in this hypothetical that let's say that the market did go up. Say now that the market price went up to 110. Oops. Now, my option should be worth at least $10, right? I think that's 10 pieces. So my option should have at least $10 of intrinsic value, right? Because it's trading at, the stock is trading at 110 in the market right now, and I have the right to buy it down here at $10 or $100, sorry. So this difference is $10, because today I could say, hey, whoever sold me the option, which is anonymous, you don't really know. You just say to the market, hey, I have this contract that gives me the right to buy 100 shares at $100. So that should be worth, that contract that you have should be worth $10, because you could just immediately buy for $100 and sell it in the market for 110 and collect $10 of profit, right? So the market's going to put an intrinsic value of $10 on that call option. But let's say at this point there's still 2 months left before expiration. So the market might give you like $5 more of value here, just because you still have time left, because the stock could keep going up to 120. So your total option value is the sum of your time value. So this is the time value. This is the total value. So it's the sum of the time value and the intrinsic value of your option. So this is the price you would see the option trading in the market in this hypothetical. It's like $15. There's a component of time value and a component of intrinsic value. But if the underlying stock is trading below your strike price, then that means there's no intrinsic value, right? It's just all time value. But as you get closer and closer to expiration, this time value erodes. As you have like 1 day left till expiration, the market's not going to give you as much value for that 1 day. Maybe it'll give you a few cents of value or something. So on the last day of the option life, the price of that option is going to converge on the intrinsic value. So if it was trading for 110, you'll see the price of your option be right around $10, right? And then if in the next 5 minutes the stock drops to 109, your option will pretty much just drop to about $9. And if it goes to like 109.50, then your option will probably be around 950. Like maybe it'll be a few cents off. Maybe it'll be like 960, because you have like a few more minutes left of life. So it's giving you a little bit of time value. But so I'll just generally sell. Well, what I really do is I never hold my options. If I just have a long call option, I'm never waiting to the last day to sell it, because now all my time value is gone, right? So generally, if I'm buying a long call option, I don't really like to buy anything that has less than 3 months left on it. And so if I buy one that's maybe expires 6 months from now, and 3 months go by, and I only have 3 months left on it, I'll typically sell it and buy a new option with a longer time span on it. That's called rolling your option. So that way you can decrease the amount of value that leaks out from your option contract from time decay, if that makes sense. Let's see, switch this. So I don't know, Danny, if that answered your question in a very long roundabout way. But yeah, I don't hold options. I don't exercise them, and don't generally hold them to expiration.
Yep, we're good.
Okay. So the big takeaway, I guess, that I want to stress, especially for those who are looking to invest with options, kind of geared toward retirement, is that you can basically replicate. So think of a portfolio of stocks that you want to own for your retirement, you can basically replicate that with using much less capital by buying longer dated options. And let me, I guess, give you a real life example for my own portfolio. So, so I recently, for example, had Facebook shares in my retirement, right? And I sold. To me, I felt like I wanted to, especially with the pandemic. So this was probably back in March. I felt like I wanted to have more cash in my portfolio to take advantage of a plunge in the market, right? Because when you want the cash the most is typically when people don't have the cash, and that's usually in a market panic, right? So it's good to kind of pre-plan and have some dry powder, have cash in your portfolio all the time. Me, generally speaking, I like to hold 30 to 40% of my portfolio in cash at any given time. And ideally, when we're in a downturn, I like to have 50+% of my portfolio in cash, so that I have a lot of money to put to work when prices get really cheap. And so with Facebook, I think at the time I had like 50 shares or something in my portfolio, and let me think. I don't remember what it was trading at. Let's say it was trading at around $200 a share, right? And so what is that? Let's say it's like, okay, $10,000 worth of Facebook. What I did was I actually just bought a call option that gave me the same exposure as 50 shares of Facebook. And that cost me a fraction of that 10,000. So I sold the shares, got $10,000 cash, and I think the option I bought, and I bought a deep in the money call option that had, I think, I had more than 6 months left, and I probably paid maybe $2,000 for that option, right? So I had about, so I got 10,000 in cash, bought a call on Facebook that gave me the same exposure as 50 shares. So I had a 50 delta for 2,000. And then I was left with $8,000 in cash to kind of increase my cash reserves in my portfolio. If Facebook went up, I would still get the same upside that I would if I owned the 50 shares. And actually, as I'll explain in a minute, I would actually even do better than I would have if I had the stock, because when you have an option and the stock goes up, your delta, which I don't know if we've talked about, have you guys talked about delta and the different Greeks in your Rule 1 classes?
Not very much.
They talk a little bit about it, but they don't go into detail telling you what all it is and everything.
Yeah.
I mean, I know what it is, but they don't go into detail. That's just one of the criteria they have on some of the trades. They tell you to look for a delta of this, but they don't tell you why or what it really is.
Yeah. Okay. Yeah. Delta has a few different ways of thinking about delta, and that's what makes it confusing because they're all correct. So a lot of times you'll hear delta is the likelihood of being in the money at expiration. So if you buy a 50 delta strike, that's usually an at the money strike, meaning it's a strike that's equivalent to the current stock price. So in Facebook's case, if it was trading at $200, the 50 delta strike would be the $200 strike. So it's right at the money, which makes sense because at that point, if you're buying a strike that's at the current market price, and we talked about this in past live sessions, the options pricing model is going to assume you have an equal probability of the underlying stock going up or down from any given point, right? 50% chance it's going to go up $1, 50% chance it's going to go down $1. And so delta can tell you but I think it's a little bit wrong, but can tell you the probability of being your strike being in the money at expiration. I don't necessarily like to really think about it that way. What delta also tells you is how much your option will change in value for every $1 increase or decrease in the underlying stock. So if I bought a Facebook call with a delta of 50, and remember I was buying the 200 strike, let's just say in this example, if Facebook went up $1 to $201, my option would increase by $50 in value. So in this example, I think I said I bought it for 2,000, right? That option. So a $1 move in the underlying should result in about a $50 increase in my option. So it'd be $2,050 would be the new value of my option, right? If the stock went up $10, then roughly speaking, since I have a delta of 50, I would do 10 times 50, should be 500. So my option value should go up by 500, so to $2,500. So another way of thinking about delta then, if that's the case, if it tells you how much it moves for every $1 movement in underlying shares, then you can also think about delta as being the equivalent number of shares of exposure, right? So if I have a delta 50 strike, then that's pretty much like I have 50 shares of the underlying. So in this case, the underlying stock is Facebook. If I bought a 20 delta call, then it's like I own 20 shares of Facebook, because I will get the same exposure as owning 20 shares. So if it goes up $1, I make $20. If I own 20 shares of Facebook and went up $1, I would make $20, right? So you can that's the way I like to think about delta. And so if you're trying to replace your stock with an option, you can just say, how many shares of this stock do I have? Okay, I have 75. Okay, I'm going to go see what the 75 delta strike is and buy that. And then you would get the same upside and the same downside, roughly. But I'm going to actually say it's actually better. You have better upside and better downside. I'll explain in just a minute why. Slightly better. Does that make sense? I don't know. It's kind of a difficult concept to grasp at first.
So I get all that. It's fine. I'm just curious. What are you using to figure out your time, your expiration of your options? So like on your exposure on Facebook, you wanted to get the same amount as 50 shares, but how long did you do and why?
Yeah, like I said, I don't like to go less than 6 months, especially if it's a long-term position, right? And so, I could buy 9 months out, an expiration that's 9 months out. And then once it gets to around the 6-month mark, I'll probably roll it, right? Definitely when it's getting down to like 4 or 5 months, I will roll the option, meaning I will sell that one and I'll buy another longer dated option. And that's because of the time decay. You don't want to just have a lot of the value of your option wasted because time's ticking by. When you're buying kind of long dated options, the time decay is much less than when you're buying short dated options.
Yep, gotcha.
Okay. So if you are doing, I kind of call this like stock replacement therapy. So if you're doing this strategy where you are essentially replicating your portfolio that you would like to have with shares, but using options, it takes some active management because you're going to want to constantly roll your options so that you don't lose a lot of value because of time decay. So that's one thing. But I think the benefits outweigh that work. I mean, it's like once every few months do I have to go in and roll the option, right? I'll show you those benefits in just a minute. But so I think I kind of touched on most of this. I mean, you have, if you were to use options, you'll have much more cash in your portfolio and have the same upside exposure. And then when there's a crash, you would have the cash there to put to work. And that's exactly what I was able to do with this crash in March, because I had freed up a lot of cash by doing this. If I just own, like if I was 100% invested and I had all these shares, I wouldn't have been able to take advantage at the bottom. And also options, this kind of talking more about maybe what I do in the my personal non-retirement account. That's more of a just for side income and that type of things. Options do, there's a bunch of different strategies, and there's ways that you can make money in up, down, or sideways markets with options. So you don't actually even need the stock to go in one direction or the other to make money. See if I can get this to, there we go. Okay, so this is what I wanted to touch on, the kind of the benefits I was alluding to when you buy a call option. I like to think about call options as automatic buying and selling machines. So it's kind of like a little robot or computer that automatically buys and sells shares for me. And let me just go back to that example with Facebook, right? So if I have that 50 delta option, let's write that here, 50, it's very hard to write on a computer, which is kind of like owning 50 shares. That's what I explained, right? When I have a 50 delta option. Now, delta is not a static number. So as the underlying stock price, I think in our example, we said the shares were trading at $200 and I had the $200 strike. But as the shares, do it this way. As the shares go up, let's say it goes to $220, and I own this. This is the level of my strike, right? I own the $200 strike. This is my call option. So while it used to have a 50 delta when the stock was at 200, as the stock price increases, meaning I'm getting deeper in the money, my option is getting deeper in the money, right? Then my delta is actually going to go up. So the deeper in the money your strike price goes, because the stock price is going up, your delta is going to increase. So maybe now instead of a 50 delta, my delta is going to be 60. So that means from this point here at 220, for every dollar increase in the underlying stock, my option is going to increase by $60 instead of 50. So I'm making money faster and faster. So it's as if I had this machine that's automatically, as this goes up, the stock price goes up, is automatically buying me more share exposure, which is a nice feature to have, right? It's kind of like as the market moves in the direction you wanted it to, you start making money faster and faster because you're getting your delta's increasing. which is why just plain vanilla call options can be so powerful. Is and this is kind of what happened with my Facebook position. I mean, 'cause Facebook, hit $300 last week and earlier last week, and then the last couple of days have been bad. But so originally, I think I wanted to replace about 50 shares with my option, and now I think that whatever call I have is probably an 80 delta. So I now have like magically 80 shares of exposure. So it's kind of like that exponential curve thing. It's like the deeper in the money it goes, you start to make money faster and faster to a point. I mean, once you get to like a 90 delta, it doesn't increase, because a 100 delta is the max. So as you approach that, it starts to slow. But anyway, so that's a nice feature on the upside. Now, if the stock were to go down, so you are, let's say it was at 200 and went down to 180, my delta would also go down. So as you get more out of the money, as your strike gets more out of the money, your delta goes down. So maybe it would be down to like a 40 delta, which is also a nice feature to have, right? So if the stock is going to move against you, you would like to have less and less exposure. And so it automatically gives you less exposure because your delta is decreasing. So you're losing money slower and slower as the stock goes down. So it's kind of like an ideal situation, right? It's you want to be having more and more exposure as the stock is moving in the direction you want it, and you want to have automatically less and less exposure as the stock moves more and more out of your favor. Does that make sense?
It
Yeah,
does.
that's
Okay.
fine. Thanks.
So I think a lot of people underestimate the power of like a plain vanilla call. There are some things that you do need to watch out for with a plain vanilla call. I mean, options can be expensive if volatility in the market's high. So you don't necessarily want to buy a plain vanilla call when there's extreme volatility in the market, because that's getting priced into your option. So you may be buying your option at a higher price than you would like. Okay, so this is something that I wanted to touch on because I think in the value investing community, you'll notice there are people who are very strict kind of value investors or deep value investors, and so they will only invest in stocks that they calculate the intrinsic value, and it's like selling at half of what the intrinsic value is. Right? I mean, so Phil Town is a little bit like this, in my opinion. He is a very hard-nosed value guy, although I don't know if his portfolio truly reflects that, because I think he now has like a public fund that you can view what he owns. I don't know if you guys have heard of it, heard this. I think that I saw a news article just a few weeks ago, but he has so if you manage money, you often have to, at a certain level, you have to file a quarterly filing. I think it's called the 13F filing, and it shows what you own in your portfolio. So that's a publicly available document. So I think I saw some YouTube videos where people analyzed his 13F filing. He did own some like kind of deep value stuff, but then he owned like Ulta was one of his big positions, the cosmetics like retailer, and it's by no means kind of what a traditional value stock would be. So I know he talks a lot about calculating the intrinsic value and buying like at a super steep discount to that intrinsic value. I'm not sure if he actually does that in practice based on his portfolio. But yeah, I'd like to get your thought. Is that what generally is Phil Town kind of a really deep value guy?
Yeah, he is.
Yeah.
Indeed, yes. He suggests that we buy it 50% below its intrinsic value.
And I'm all for that, and that's my preference as well. But if you took that approach over the last decade, you would have like gotten your face ripped off because value has drastically underperformed what you would call momentum over the last decade. And so deep down, like I struggle not buying anything that's not like a super steep discount to what I think is intrinsic value. But so I think I've kind of learned over time that I think it's good to do both, to kind of have a mix of both in your portfolio, just like diversifying different industries. These are called factors. So I don't know if you've heard of factor investing, but there's different factors, kind of underlying characteristics of stocks that people will study, like academics will study to try and see, does that factor generate returns above and beyond market returns, which they call alpha, right? And value and momentum are two factors, meaning value meaning you're buying the cheapest stocks in the market, and momentum meaning you're buying the stocks that are outperforming the market by the most. And if you look at the research, there's a couple of good books on this as well. There's one called Quantitative Momentum by Wes Gray, and there's another one called Quantitative Value, also by Wes Gray and another guy, Tobias Carlisle. I really like listening to their stuff and reading their stuff, but they explain, that these two factors, buying the cheapest stuff and also buying the stuff that's outperforming price-wise the market, tend to give you the best returns over time. And the interesting thing about these two factors is that they kind of are counter to each other. So when momentum is doing well, value struggles. And when value is doing well, momentum kind of lags. So having both in your portfolio can kind of be a good way to diversify and kind of play both sides, right? So that's why I like to tell people is I wouldn't necessarily. It's kind of like anything in life. If you are stubborn and refusing to look at the other side, then you might be missing out on, in this case, half of your potential returns. So it's a lot of times in life, it's good to kind of be able to see both sides of it and not necessarily just be in one camp. So the value factor works, they have found, because and you also have to do a lot of your own homework on these different stocks, right? You want to make sure it's not a situation where truly the business is going down the toilet. I mean, you want to be in a stable business and maybe it's just having a short-term issue. So value works because the market overreacts to some bad news about a stock, right? Maybe they've had a couple bad quarters, and like I said, these institutions, they just once you're kind of branded as a struggling company, or maybe your growth drops instead of going up consistently every quarter. Maybe you had a quarter of year-over-year decrease in value in growth, then it's like you're toast for the next few months at least. And so the market just overreacts to the bad news and unduly punishes the stock. And so what you're betting on when you're buying a value stock is kind of a reversion to the mean, or coming back to reality that, okay, this company's not as worse as everyone thought after that bad news. right? Let's not freak out. It's still a good business. That was just a temporary hiccup. So the example I just put on here that just came to my mind was Camping World. This is a stock that I followed for a couple of years. This is Marcus Lemonis. I don't know if you watch the TV show called The Prophet on CNBC, but Marcus Lemonis is the guy in the show who makes investments in small businesses and tries to turn them around. And so it's an interesting show if you haven't seen it. But he made his fortune by founding Camping World, which is primarily an RV dealership. So they sell new and used RVs, mostly in North America. I think exclusively in North America. I don't think they have any international operations. And so this stock, this is a multi-year chart, but you can see that it had struggled for the last few years, going from a high of 40 all the way down to the March lows with this pandemic it went down to 4. And I guess this also teaches a lesson of using options. So I had actually bought some options back here last year, kind of in the summer. Had some success. It was trading in the $10 range, went up to 15, had some success. Still had some options around here when the market plunged. But the nice thing about options is is that I only lose the amount I paid for the option, which is maybe a few $100s for one option. If I had owned the shares, I would have lost much more. But when it got down to the $8 range, based on kind of my calculation of fair value was around the $20 range. I thought it was pretty cheap. And then when it hit 4, I loaded up the truck because it just seemed crazy. At $4 a share, I think it was the market cap of this company was around 200 to 300 million. But if you looked at their financials, and this is a tricky company if their earnings look bad, but if you look at their cash flows and earnings can be different, just based on accounting rules and all that. Cash flow, in my opinion, is the more important metric. So if you look at how much cash the business took in, their cash flows were around 200 million in the past year. And now the company was selling for a value of 200 to 300 million, which seemed crazy, right? It's like 1 times cash flow. So, but it always makes you feel stupid because I bought at 4, I bought some at 5 and went down to 4 and bought some more at 4, and it kind of hovered around there for a while. It's like, am I missing something? And you got to ask yourself that question, because the market is generally pretty smart. But in this situation, what happened was just everyone was so panicked that everything was being sold. Everyone was thinking, who in their right mind would go buy an RV right now with the uncertainty, right, with everyone's jobs and all that. And so I think, for a lot of people, it made sense to just sell Camping World. It's going to be a horrible business for the next few years, potentially. And this wasn't my own insight, but I also read around this time that, the only vacations people are going to be able to take are camping and outdoors type things. And so, potential that a lot of people start buying RVs. And that's exactly what happened, is like they were having record sales. And then suddenly they announced quarterly earnings and said, yeah, like we've sold more RVs than we've ever have. And the stock took off. And it went way higher than I ever could have expected. I didn't hold it all the way. I still have some shares, but the vast majority of my shares, I sold by around $25 to $30. But that's an example of value, is just finding these companies that are unduly beaten down and punished when really their business isn't that bad. Any questions on that?
No, that's fine. Thanks.
Okay. And I know we're running out of time, so I think we may have to do the, well, I guess if you guys want to stay on, that's fine. If not, we can just do the put selling, which is the next thing after this slide. We can do that in another session.
I'm available to stay on.
Are you okay? Well, that's great. If you're available to stay on, then we can go through it. But I didn't want to hold up any of you if you guys needed to go. So feel free if you need to go after this last slide here. Feel free, and then Arlene and I continue to put discussion. But if you want to stay for that, then that's great.
Yeah, I can stay on for a bit as well, Steve. I'm not sure if I can stay on for the whole lot, but we'll see.
Yeah, and I don't think it'll go more than another 20 to 30 minutes. So
That should be fine. Thanks.
okay. So momentum is, you know, I put here is the active investing stocks that have outperformed the market price-wise over a period of time. So if you take a stock and maybe it's gone up 30% over the last 12 months and the market's gone up 10, and it's maybe in one of the highest deciles of outperformance, and then those are what we're talking about, are momentum stocks, the stocks that just seem to keep going up and outperforming the rest of the market. And those stocks tend to look really expensive when you kind of try and value them. And the reason that momentum works is because the market just struggles to fully appreciate how good that company is. And so it's kind of like the market is slowly realizing how good the company is over a extended period of time. And so as more and more is realized about the quality of this company, the stock goes up more and more. And so for a lot of kind of hard-nosed value people, it's so the example I have on here is Tesla. It's that's why I say, like, I wouldn't get too entrenched in any one position. For a long time, you know, for the last several years, you know, I didn't even really look into Tesla because every value investor that I follow has been saying how overpriced Tesla is for the last, you know, 5 years or so. And so I didn't even look at it. But I did come across some articles and some, I think I watched some videos and read some different things that kind of changed my mind last summer. And this is when Tesla got, so if you can see on this chart here, Tesla got beat down this is February last year. It's kind of a blip on the screen because the stock's done so well. But last summer, Tesla got beaten down. I think the stock was like at a high of 500 and went down to 200. And that's when I started getting interested, and just seeing. And a lot of times, it's things that you can see in your everyday life occurring. You know, the number of Teslas that I was seeing on the road was growing exponentially over a few month period, right? And that got me looking into it more. And then just seeing how really the entire industry is moving to electric vehicles, and how you read books on like disruptive innovation and how most companies are not set up to make a change in the changes they need to survive for the next 20, 30 years. And you could quickly see how really the traditional automakers were not willing to make the sacrifices and changes they would need to make if they really wanted to be around for the next 20 to 30 years. And how companies like Tesla were probably the replacements for these companies. And not to mention that Tesla had extreme brand value, like it was becoming the Apple of cars, right? And the Apple of like any renewable energy, which is kind of like what millennials are seeking after. And so doing some back of the envelope math, and this is another situation where pay attention to the cash flows, not the not the earnings, because a lot of these companies, I mean, even Amazon and Netflix that have been on tears for years, they haven't shown much profit on the income statement, but that's because of how accounting works. And if you're spending a bunch of money, for example, Netflix case, building content, that's getting expensed, and so you're not going to show profits on your income statement. But if you are, and that a lot of that's non-cash expense, and if so you're having to put it as down as an expense when you haven't actually spent the cash. And so if you look at the cash flows, that oftentimes tells you gives you a better picture of the true underlying fundamentals. Those companies have positive cash flows, and in Tesla's case, they were about break even when the market was saying that they're losing tons of money, and have since gone positive in cash flow. So right around the $200 level, I made some investment in Tesla, not as much as I would have liked in hindsight, right? But you're never sure about these things 100%. And so that one, it has been outperforming for years on price, and you would not view that as a traditional value stock. But there's stocks like that, like I said, Netflix, Amazon, where if you start seeing recurring outperformance, there may be something there to it, and it's hard to just see from the income statement. And so you can oftentimes find some of your best investments in the momentum space as opposed to the value space, if that makes sense. Any questions there?
Maybe more of a general question on momentum versus value. Momentum has been going strong for a while now, and I know that because I've been focused on value, being a disciple of Phil Town, or at least
Right.
getting momentum companies dirt cheap, but they're never dirt cheap. And we're heading into fall. Traditionally, that is a high volatility season. What's your strategy right now for momentum? I mean, I can't picture myself buying a lot of these big names outright, like the Amazons and the Facebooks.
Right.
So I guess is it selling puts?
Yeah. So that's one strategy. Yeah, is selling puts, and that's the nice thing about selling puts is you can kind of predetermine the price that you'd be willing to buy, right? And if it doesn't get down to your price, then you just get to keep the premium. So it's kind of like, okay, I still make money if it never comes down to my price. If it comes down to my price, then I get to buy the stock at the price I want, right? The problem though on a lot of these high price stocks is selling puts is difficult
Yep.
because you would need a ton of money, because you need to have the collateral for 100 shares, right? Or a big portion of that. If you have a margin account, you don't necessarily need the full 100 shares worth of collateral. But yeah, so like on a Amazon, it's trading at 3,000 plus, right? 3,000 times 100 is you would need $300,000 to potentially sell a put. So it's a lot of times it's not feasible to do so on a high price stock like that. But I guess my current thoughts are that I do think a lot of these momentum names are overextended. I mean, you're seeing them take a breather over the last couple days.
Right.
And so it is risky to be in these. And so there are certain strategies, option strategies, where you're not risking a lot. So it's kind of like you make some decent returns, but you won't lose a lot if you're dead wrong and these sell off hard. Whereas if you own the shares, you would probably lose a lot more. So for example, And Tesla, in my opinion, has gone too far, too fast. So I actually did a option strategy when it hit about $900 a share. This is pre-split, so it's split since then. So pre-split, when it hit about $900 a share, and you know, it went all the way up to like, I think it got up to, I mean, it got up to like $2,500 at its peak prior to the split last week. But at about $900 a share, I sold my shares and replaced them with a bull call spread. It's a debit spread. So I bought a call. Specifically, I bought the $660 call, meaning I have the right to buy the shares at $660, and I sold the 860 calls. So that's a $200 wide spread. And so I take it back. I sold the shares around 800. And at that time, I could buy that spread for about half the width of the spread, which is so a $200 width spread. So I think it turned out to be is less than half. So it was about $8,000, I believe. And the potential value of that spread, if the stock was trading above my upper strike, let me just write this out because I know it's confusing to. So I sold this 860 and I bought the 660 strike. And so this is a $200 wide spread. If the stock is trading above, if it's trading above this 860 level at expiration, then the value of my spreads should be worth $200 a share, but times 100, so it should be worth $20,000 is the max value of that spread if it's trading up above 860. And I think I bought this, so I bought it for 8,000. So I paid 8,000, and the maximum it could be worth is 20,000. So that means my max profit is like 12,000, right? And I think it was trading right around 800. So I was like, really, the stock really needs to just kind of stay where it is or go up a little bit for me to make this additional profit. And I sold my shares. So I'm like, okay, I sell my shares. I still have upside through this spread. And then if you do the math, it's like, in order for me to make the same profit, the stock would actually, if I owned the shares, stock would have to go much higher than 860. And so this seemed like a good setup for me. And so it turns out that I drastically underestimated how much, I thought kind of like the $1,000 level was maybe the max it would go. And that was about fairly valued. And I could never have dreamed that it would go all the way up to like 2,500. So had I kept the shares, I definitely would have been better off. But I still made a profit on this spread trade, but not, I think I left like a lot on the table by selling the shares. But you never know. I mean, you've got to make the best decision with what information is available to you. But in my opinion, I think Tesla is kind of overextended here pretty drastically. And if it ever dipped back to kind of like this $200 level on a split basis, which would be equivalent to the prior $1,000 level, then I think I'd be interested again. But until then, I'm probably not very interested. All right. So quickly. So it sounds like, Arlene, you understand a bit about selling puts.
I do. I do. I just haven't taken the plunge. And the reality is that when we're looking at those pages on Thinkorswim or Interactive Brokerage, there's so many different numbers and things. I'm always scared I'm going to click in the wrong spot, so I've
Right.
never pulled the trigger.
Right. Yeah, and I think there's
Yeah.
paper trading. Oh, go ahead.
That was me. You just asked what I was going to ask. I was going to ask her if she had a paper trading account.
So I have yet to start. So I decided I was going to attend the group today, and before the next session, so you guys can keep me honest, I will start my paper trading.
Okay. Yeah, I think it's good to, just learn how to navigate the tool and use it. It's like you said, so you don't make a mistake. Yeah, paper trading, that way you don't, if you make a mistake, no worries, it's fake money. So in the way I think about, and I don't know, I haven't taken Phil Town's course, so I don't know how he explains it, but just in my own research and in my own experience, the way I like to think about it is selling puts is like being your own insurance company. And we know that Warren Buffett kind of made a lot of his fortune from the insurance industry, because he takes the float from their insurance operations and invests it in stocks and makes a return on that float. So with puts, you can actually become your own mini insurance company, and you don't need any like approval from the government or whatever to start this insurance company. And what are you insuring? You're insuring the price of stocks, right? So if you have let's say a stock that's trading for $10 a share, and you sell a $9 put, that means you are taking on the obligation to buy those, to buy 100 shares at $9 from the person who bought the put from you, right? And so if the stock goes down, you're saying, I'll always buy it from you at $9, even if it goes down to 5 or whatever. So you're providing that insurance to the buyer of that put option. And in exchange, the buyer pays you, the seller, a premium, right, which is the price of that option, and you get to pocket that cash, and you never have to pay it out unless there's a claim made on the stock. And the only way that would be, a claim would be filed and made that you would have to pay out on is if the stock price went below that strike before expiration. So that's kind of how I like to think about it, as like a mini insurance company. And the nice thing about this is that a traditional insurance company, it's not like when they pay out a claim, let's say an auto insurance company, you crash your car, they pay for the damages. The insurance company doesn't get anything in return. So this is kind of even better than a traditional insurance company, where you actually, if you have a claim made and you have to buy someone's stock for $9 and it's trading at $7, you at least have that stock, right? So now you own the stock, and if it's a good company and it bounces back, then you really didn't lose anything in the end. So it's the best type of insurance company, I guess. And you get to choose which stocks you insure. So it's not like you're having to insure every stock. You can pick and choose the best ones, and the ones that you maybe want to own, right? Because you could end up owning them if you get put those stocks. So any questions?
No, I'm good there.
Okay. So maybe I'll just show you really quickly if I can do this. Let me see if I can switch screens here. I'll just show you in Thinkorswim really quick. maybe an example.
Arlene, are you trying to figure out if you're going to use Thinkorswim or Interactive Broker?
So I'm in Canada, so we have a lot of premiums with Thinkorswim. I think I'm forced to use interactive brokers, but I know Thinkorswim is much more intuitive.
Yeah.
Did you have some advice for me on that?
Whenever I first started, I used both because when you were doing the Rule 1, they gave you, if you signed up with a specific code on
Yep.
Interactive Broker, you got a discount on your commission. So I wanted that discount on my option trade. So I put money in Interactive Broker mainly for doing option trades. And then I had Thinkorswim already set up before I ever took the class. And I kind of was keeping my stocks and options separate in a way, to the best of my ability. It didn't always work out, but I used both. And I got to where I learned Interactive Broker. And once you learn it, it's not that difficult, but it is a lot more. Thinkorswim is a lot more intuitive and makes more sense to me. That's why I was asking. But I get if you're in Canada, then you don't have that many options. I will tell you this: if you go to YouTube and just type in Interactive Broker, there's like 5 or 6 real short tutorials that'll teach you everything you need to know about it real quick. Those help out more than anything.
Oh, nice.
That's awesome. Thank you so much. I'll try that out. Appreciate it.
No problem.
So this is a smaller cap company, Seritage Growth. So I actually just and you, as an investor, you will want to kind of just.
I don't see anything.
So you can't see anything on my screen here?
No.
Let me
No.
see. Maybe this screen isn't. Oh. Can you see it now?
Yep.
Yeah.
Yeah. Now.
Okay. So you can see my Thinkorswim open, right? And so I've got this chart of SRG, which is Seritage Growth. So this is a REIT. So this is a real estate investment trust. They own. This is kind of a spin out from Sears. So Sears went under and went bankrupt, but they owned a lot of property, and so they spun that the property they owned, a bunch of buildings, a bunch of the Sears buildings and other real estate they owned, spun it out into this Seritage Growth. You could see that it was trading much higher last year in the $45 range, and just crashed all the way down to $5. And I learned about this on a podcast. There's kind of a group of podcasts that I listen to that I've found kind of interesting. They bring on different investors and they talk about different ideas. So that's one lesson, is just to always kind of be looking for ideas and maybe have some different sources of potential ideas that you go to. And I think maybe in the Discord group I'll list some of the podcasts I like, and maybe some of the YouTube channels. And also there's the Value Investors Club as a website that you can go on where people post ideas. A lot of them are junk, but this one seemed interesting to me. And the guy on the podcast was talking about selling puts on this particular stock because he didn't see a huge downside, because the underlying value of the real estate was a multiple of what this stock was trading for. So I think it was, if I remember right, it's like a $400 to $500 million market cap, and but they've got a bunch of debt. So your enterprise value is maybe $2 to $3 billion, and he thought the underlying real estate was maybe worth $5 billion. So he thought it was really trading at kind of half of what the underlying real estate was valued at. And so it was interesting to me. And the nice thing was the implied volatility on the stock was pretty high, meaning that options are selling for fairly high prices. And so if you sold a put, if you're a seller, you want high option prices because you're selling. And so I was able to, let me just show you the option chain here. So I was able to buy a put that expired in August. I bought it right around when the stock was trading at $9 range, and I think I sold the $9 put. So that means I was willing to buy it 100 because I was actually wanted to invest in it. So I was like, oh, I'm fine buying for $9. So I think I sold that put, and it expired in 2 or 3 weeks from then for about $60. And so I collected $60 of premium. If the stock was trading below $9, somebody would sell it to me for $9. And I collected $60. So really my cost basis would be $8.40. So 60 cents per share, $60 for the contract. So my cost basis would be $8.40, right? Because I would buy it at $9, but I took in 60 cents per share of a premium, $60 total. So I would my cost basis would be $8.40 a share, or $840 for 100 shares, which is a fine price. I was like, oh, I'd be happy to buy it at that price because I think the value is somewhere maybe in the $25, $30 range. But the stock never went down below $9, and it actually went up to like 15. And those put options that I sold quickly became near worthless and ended up expiring worthless. So I just kept the $60 a share, right? Or $60 per the contract. And now September, I just sold another put. Can't even remember what put I sold. Does this tell me? Oh, okay, yeah. So I sold the $12 put. You can see over here. And one thing that you can do when selling puts is you can actually, instead of really selling a naked put, which is just selling the put and that's it, you can then buy a lower strike put. So you're really creating a credit spread. It's really a spread, but you're buying the put that you're buying is pretty far out of the money. But the only reason I bought it is because it was like 5 cents. I think I sold this one for around $1, so $100 for the contract, and then I paid $5 for this one. So I think I collected like $95 of premium. But that way, by doing that, the only collateral TD Ameritrade requires is the difference between the spreads. So there's this $12 strike and the $8 strike. So that's $4 times 100 is $400. So the collateral I had to put up is $400. If I didn't buy this $8 put, I would have to put up $1,200 of collateral because I'm selling the $12 put. So you have to do, 12 minus 0. That's the collateral you'd have to put up. So by spending $5, I could just basically decrease the collateral needed by $800. So that's something you can look out for when you're selling puts, is like, could I actually just do a spread? Maybe it's pretty widespread and not have to put up so much collateral. And that's one thing you could do on those more expensive, higher price stocks where you don't have the cash to put up for collateral. So so if everything goes okay, and actually the stock went up after selling, I think I sold that put right around when it was around $12, and now the stock's at 15 again, and you can see the value of this option. I sold it for like 100 or $1, and it's 20 cents. Right, so it's gone down dramatically, and that was probably a week ago. So it just, on this one, turned out to be, you know, a lot of that's probably luck that it went up quickly after I sold that put. But so you can see just in a matter of, you know, this expires on the 18th, probably put this trade on last week. So just in a matter of weeks, you know, I'm collecting $1 of premium on a stock that was trading at $12 at the time. So it's like 8% of the value of that stock. And if the worst case scenario, I get put the stock at $12. When I subtract out the premiums I've collected, you know, so far this is my second trade on this. The first one I collected about $60. This one I collected about $95. So let's say I've collected $150 total. So really, if I bought it at 12, then my true cost basis would be down at 1050, right? But if I never get put the stock and I never own the stock, I still have collected that premium. And on an annualized basis, you know, I'm making this. In this case, I've only risked $400 in collateral and making about 95. So it's almost a 25% return on that capital that was at risk in a matter of maybe 3-4 weeks. And so if you do that on an annualized basis, you can see how your returns could far exceed the returns of the market, which is, you know, maybe you're expecting like a 10% return on an annual basis. And this was giving me an 8% return in like a 4-week term duration, right? So what we can do in future, and actually might do a recorded session on this, is getting more into the details of put selling. I don't know how much in the weeds Phil Town would go in his course, but there are different adjustments you can make, different things you can do. You know, for example, if this stock goes against you and you don't want to buy the stock, there's different, you can roll it out and do some different things to avoid getting put the shares. And so we can talk about some of those adjustments maybe in later sessions. I did read some research, and somebody who does this strategy look back on his trades over the last few years, and it was like a 95% win rate if you take certain corrective measures, where you sometimes just have to keep rolling and rolling and rolling for a few months. But we can get into those in a future session because I know we're way over time. Any final questions?
Yeah, I got one. So the way you did that trade, so where you only had to put up $400 in collateral, do you have to do that spread at the time of the purchase, or can you do them separate? So, like, if you sold the put and it used 1,200 collateral, and then you went and did the other trade, do you know if they give that collateral back when you do the other trade?
Yeah, it will. I mean, if you have a good broker, it should automatically readjust the collateral that they're holding. So yeah,
Gotcha. That's what I thought.
Yeah, good question. And you know, sometimes that may be you know, that may be a good strategy. So for example, if I just sold the $12 put and then the stock went up, right? Like in this scenario, let's say I sold it for 95 here, and let's say I didn't buy this $8 one. Here's the prices right here, this last column, right? Now I could have bought like the $10 today if I waited like a week, because I think I put this on last week. If I waited a week to put my buy side of this trade on, I could have bought this $10 one for like, I don't know, 2 to 5 cents or whatever, just like $2 to $5, and I would only have $200 of collateral, right? So you could put them on at different times as well, but I didn't know what the market would do, so oftentimes you just put it on at the same time.
Yep, gotcha.
Okay. Well, anything else? If not, then have a good long weekend, and I'll post this recording as soon as I get it downloaded and everything like that. So, and if you have any ideas for kind of like future live sessions, feel free to let me know, because it's hard to know what to talk about exactly, because we have such a diverse group and we have people at all different levels, right? So for a lot of people, some of this is not new, and for other people, it is like too much. So feel free to let me know if there's something you want to talk about.
Sounds good.
Okay. All right. See you, everyone.
Thanks,
That's
Steve.
good.
Have a good Labor Day. Bye,
Thanks,
everyone.
See you.
thanks a lot. Steve. Bye bye.